Is there really a best instrument to trade? Well, this video will explain factors to consider before choosing an asset to trade on. It's BossBrain here, and let's roll in the intro. Alright, welcome to BossBrain Financial Trading Institute. This channel is dedicated to help you as a trader to attain financial freedom through financial trading. And in this video, I'm going to talk about the best financial instruments to trade. Before we get started, you need to understand that the broad categories of financial instruments fall into the currencies, the stocks, the index, commodities, the metals, the synthetic indices. The currencies involve trading currency pairs against each other. For example, the US dollar against the euro, the euro against the Canadian dollar against the Great British pound, the Great British pound against the Australian dollar against the Japanese yen, and so on. While stocks, on the other hand, involves trading companies' share price, the rise and fall in companies' share price. For example, buying Apple stocks at X amount of dollars and selling it off at a higher amount of dollar, or for example, shorting Apple stocks or shorting Tesla stocks at X amount of dollar, hoping it to fall down to X amount of dollars to take in profit. While index is index is actually a basket or a bunch of stocks grouped into one. So when you buy one index, or when you trade an index, you are basically trading a piece of every item listed on that index. For example, the Nasdaq 100. These index is actually it's made up of 100 top performing stocks listed on the Nasdaq. Then we also have the FTSE 100, that is for the UK. We also have the Dow Jones or the US 30, and we also have the Nikkei 225, that is for Japan, and we have the CAC 30, that is for France, and also German 30. And also we have the commodities. The commodities involved trading oil, or Brent crude. Oil, that is West Texas Intermediate, that is for the American oil, then the Brent crude, that is for UK oil, against a currency or against each other. While metals is actually trading gold, silver, or other precious metal like palladium, platinum against the currencies, for example, gold, dollar. Then synthetic indices is actually a proprietary asset provided by deriv.com. And under the synthetic indices, they don't follow real market conditions like peak hours and so these synthetic indices are open 247 to trade on exclusively on deriv.com. And some of these assets are the volatility 25, the boom crash index, the volatility index is the range break index, and step index, and so on. All right. The forex market groups currencies into three groups. We have the majors, we have the minors, and we also have the exotics. If we talk about the majors, these group constitute the largest shares of the foreign exchange markets, that is about 85%, and therefore they exhibit high market liquidity. This pairs as the US dollar as the base currency or the quote currency. If we talk about the base or quote currency, for example, the USD CAD, that is US dollar against the Canadian dollar, since the US dollar is listed first on this pair, it's known as the base currency, while the Canadian dollar, on the other hand, is known as the quote or counter currency. Then some examples of majors are the Euro USD, the USD JPY, the GBP USD, the AUD USD, the USD CHF, the NZD USD, and the USD CAD. And there are about 8 major currencies. There is 8 strong economies with currencies listed against each other. Then the minors, we have the minor pairs actually do not involve the USD, that is the US dollar, and the most actively traded currencies are derived from 3 major non-US dollar currencies, which is the euro, the JPY, that is the Japanese yen, and the Great British Pound. And examples of these minors are the Euro JPY, the GBP CHF, the Great British Pound against the Australian dollar, then the Euro against the Canadian dollar against the Swiss franc, the British Pound against the Canadian dollar, then also the Canadian dollar against the Japanese yen, the New Zealand dollar against the Canadian dollar, Euro against the New Zealand dollar, the Great British Pound against the New Zealand dollar, and also the New Zealand dollar against the Japanese yen. Then we also have the Canadian dollar against the Japanese yen, and so on. While the exotics are currencies from emerging or smaller economies paired with a major. Examples of exotic pairs are the US dollar, Mexican peso, the US dollar, South African rand. We have the US dollar against the Swedish krona. We also have the US dollar against the Norwegian krona. And we also have the US dollar against the Danish krona. So we've talked about the major, the minors, and the exotics. So what actually do you consider before choosing a financial instrument to trade? Well, the first thing we consider is volatility. How fast or how well does this pair or this asset move? Then what's the dollar value per point? What's the spread? The spread is actually the bid and is the difference between the bid and the ask price. Then what's the peak hours? Then also what economic data is surrounding this instrument. If we talk about the volatility, the study shows that the British pound pairs are the most volatile in the market, with an average daily range in price movement of 1,000 to 1,500 points. That is 100 to 150 pips. Then if we talk about the dollar value per point, the dollar value per point on most USD pairs are often $1 per point per standard lot. What this means is that when you open a dollar per position, say the GBP USD with a standard lot, and you are willing to risk 250 points, that is your stop loss set as 25 pips, and you are projecting to target 1,000 points in profit, that is your take profit set at 100 pips, the dollar value per pip for your trade is negative $250 when it goes against your projection, then a positive of $1,000 when it goes in your projection. This simple trade gives you a risk to reward ratio of 1 to 4. Then if we talk about the peak hours, the financial market based on time is grouped into 4 sessions. We have the Tokyo or the Asian session, we have the Sydney or the Australian session, we have the London or European session, we also have the New York or the US session. The Tokyo session, one thing to notice is that Japan is the 3rd largest trading center in the world. So typically trading momentum will pick up during this session, but not as much as the London or the New York session. The yen is the 3rd most traded currency in the world overall. About 21% of all forex transactions takes place during this session. Then since the Tokyo session is when news from Australia, New Zealand and Japan comes out, this presents a good opportunity to trade news events. There could be more movement in JPY pairs as the yen pairs. It is more likely that you see stronger moves in the Asia Pacific currency pairs like the Australian dollar against the US dollar, and also the New Zealand dollar against the US dollar and the USD JPY, as opposed to non-Pacific pairs like the Euro USD. Then if we move on to the London session or the European session, just when the Asian markets are closing up shop, the Europeans are just starting their trading day. Then London is considered the largest forex capital of the world, with thousands of businesses making transactions every minute, and about 30% of all forex transactions happen during the London session. This session does overlap the New York session, which we will talk about later. Because of the volume of transactions that take place, there is so much liquidity during the European session that almost any pair can be traded. It would be best to stick to the majors such as the Euro USD, the British Pound against the USD JPY, as these pairs typically have the tightest spreads. Also, it is these pairs that are normally directly influenced by any news report that comes out during the European session. You can also try the yen crosses such as the GBP JPY, that is the British Pound against the Japanese yen, and also the Euro against the Japanese yen. One thing to note before we move into the New York session is that each of these sessions is open 8 a.m. local time. So the Tokyo session is actually open 8 a.m. in Tokyo. That is, and also the London session is open 8 a.m. in London. So whatever country you are watching this video from, you just simply take the time difference of Tokyo to know, and match it with your own local time to know um, when the session will open and close in Tokyo and London, and also the New York session. So if we move on to the New York session, just like Asia and Europe, the US session has one major financial center that the markets keep their eyes on, and there will be countless opportunities for traders to benefit from this session. One thing to keep in mind during the New York session is that you will find the most liquidity and volume during the first couple of hours during this session, because it overlaps the London session. Along with most economic reports being released during the US session, once European markets close shop, liquidity and volatility tends to die down during the afternoon US session. And also there's very little movement during Friday afternoons, as Asian traders are logging off their trading decks for the end of the trading week. And also on Fridays, there is a chance of reversals in the second half of the sessions, as US traders are closing their position for the week. Take note that there will be ton of liquidity, as both the US and European market will be open at the same time. This allows you to trade virtually any pair, although it will be best if you stick to the major and the minor pairs and avoid those weird ones. You can also trade commodities such as gold, silver. You can even trade index funds such as the Nasdaq 100, the Dow, that is the US 30, or the S&P 500, that is Standard & Poor's 500. Before we move on, let me tell you why most traders lose money while trading, and I hope you are taking notes and make sure you understand these, like why traders lose money while trading or in the long run. There are three reasons actually. One, no money and trade management plan. Then two, they ignore volatility. And three, they cap their upside. Financial trading is all about money management. If you don't have that, you're always gonna lose no matter what. But if you got the right money management in place, you could pretty much flip a coin on every entry and you're still gonna make a lot of money in the long run. So keep that in mind. Money management is key to success in this business. Nearly every losing trader has no money management or trade management plan. I still think that it is even better to look for the best possible entries to make the odds of success as high as they can be. But it's possible to make a lot of money just by having the right money management and trade management system in place. If you want to become a consistently profitable trader, you need to have a good money management and also a good entry and exit strategy, that's for sure. I'm telling you, almost nobody got both of it. They either have a terrible plan in place that doesn't fit for the different types of market, or they just have no plan in place and just trade by feel. Believe me, trading by feel is dangerous. Then the second reason, nearly every losing trader ignores volatility. So many forex traders have a trade management system in place that says to enter X amount of lot for every trade. Never mind that the British pound against the New Zealand dollar has almost 3 times more volatility than the euro against the British pound on the daily chart. You cannot trade them the same way. As a professional, you need to adjust your lot size, your stop levels, and take profit depending on the market conditions. Then the third reason is that nearly every losing trader cap their upside. Another common way of managing trade is to have a profit to loss ratio, that is a risk to reward ratio of 1 to 2, 1 to 3, 1 to 4, 1 to 5, even up to 1 to 10, 15, and so on. The problem these ratios are is that you cannot ride the big trend, and this is what is holding many people back from becoming consistently profitable. Trust me, having a risk to reward ratio is good, but you need to understand that long runs, big successful trade combined with cap downside makes a consistently profitable trader. So make sure that you give the market a chance to fill your pocket with a big move every time you enter a trade. Please understand that it's all about catching the big trends. That's how we make money in this business. Alright, if we should do a recap of everything we've learned so far for the past 10 minutes. It should be one, we talked about the broad categories of financial instruments that are tradable. Then we also talked about the currency group. Then we talked about the 5 key information to know about any instrument. Then we also talked about the financial market sessions. Then I further discussed why traders lose money. I hope you've been taking notes. And this is the BossBrain Financial Trading Institute. You can also visit bossbrain.xyz to get more articles on financial trading. And also check the link in the description to join my Telegram channel. And if you do like this video, give it a thumbs up. And if you haven't subscribed, subscribe and turn on the bell notification. Until next time, take care.